If you own an independently run business with fewer than 500 employees, then you're essentially a small business. Since the COVID-19 pandemic, the number of registered small businesses in the US has ballooned to 33.2 million. That said, starting a successful business is one thing, understanding your business taxes is another. Unfortunately, most business owners have very little knowledge of business tax planning, especially how to save on these taxes the legal way. So in today's video, I'll share the top tax planning tips for small businesses that will keep thousands in your pocket. So like, subscribe, and let's get right into it. Now, unlike working under an employer where the employer is filing your taxes on your behalf, being self-employed means you have to do your taxes yourself or hire an accountant. And these taxes will differ depending on the type of business you're running, whether it's a solo proprietorship, single member limited liability company or LLC, partnership, limited liability company, S corporation, or C corporation. So let's quickly look at the type of businesses taxes you should know about before we move forward onto the main point of this video, which is how you can save on small business taxes. First off, we have the individual income taxes, which are the taxes charged on the money you earn. All businesses except C corporations must pay these taxes. In this case, your tax rate is determined by the income tax bracket. C corporations instead pay a flat federal tax rate known as the corporation tax. For 2024, that tax rate is 21%. In addition to these, they have to pay state tax rate, which varies from state to state. So if you have employees, you also need to file payroll taxes, which include federal income tax withholding, which comes from the employee's wages, Social Security, and Medicare taxes, which you and the employee contribute equally, and federal unemployment taxes, which comes from your own money. Then we have self-employment tax, which is basically you paying Social Security and Medicare taxes for yourself. This tax targets sole proprietorships, partnerships, and LLCs. S corporations may be able to avoid some, but not all self-employment taxes. As of 2024, the self-employment tax rate is still 15.3%. Moving on, what can you add to your tax plan this year to save hundreds, if not thousands of dollars this year? Number one is always take your QBI deductions. All pass-through businesses are eligible for the qualified business income deduction. By definition, a pass-through business is any type of establishment whose entire income goes to the investors and the owners. So we're talking about sole proprietorships, partnerships, LLCs, and S corporations whose income is reported as individual income in tax returns. Now, this tax provision allows you to deduct 20% from your taxable income, which not only lowers your overall tax bill for the year, but you can also qualify you for a lower tax rate. Now, depending on how much income your business bring in, this move alone can save you several thousands of dollars in taxes just this year. Number two is put some of that money into retirement. As a business owner, it's easy to spend every waking minute consumed by your business, but amid all the different hats you have to wear, remember to plan for your future by saving for retirement and save on your annual tax bill while at it. Currently, there are several retirement plan options for self-employed individuals and small business owners. The most common ones include the solo 401k, which is designed for self-employed individuals with no employees. So it works pretty much the same as a typical 401k. You also have the traditional tax deferred IRA or the tax-free Roth IRA. The SEP IRA, a great option for self-employed people with few to no employees. It also allows you to make contributions for yourself as well as for your employees. You also have the simple IRA, which I recommend for larger businesses up to 100 employees. And lastly, the defined benefit plan, which is a little more complicated than the others, but might be a better option for self-employed people with higher income levels and no employees. Retirement plans as a whole are tax efficient investment options since you defer your taxes now, or in the case of a Roth IRA, you make tax-free draws once you retire. Number three is keep those everyday business receipts. Did you know that many of the business expenses you put off can actually save you some bucks when tax season rolls by? For instance, your business travel and living expenses while on those travels. Basically, the IRS allows small businesses like yours to deduct ordinary and necessary expenses from your gross income at the end of the tax year. But there's one caveat. You have to prove or justify these deductions. This is where receipts come in. Keep those receipts for your business expenses, as you might actually use some of that to reduce your overall taxable income. Number 4 is deduct large purchases too. Yes, you don't want to forget the business asset purchases too. I'm talking about things like your new company car, a piece of equipment, office furniture, and office computer, and so on and so on. Since these expenses are actually significant, they can save you thousands in taxes. Number 5 is defer some income to reduce your tax rate. As I already mentioned earlier in the video, most types of small businesses fall under the federal individual income tax bracket. This simply means you're subject to progressive income tax rates. Depending on how much income your business is making, you will pay anywhere from 10% to 37%. As you can see, the higher your income, the higher your tax rate. But there is a way to go around this. If you say you made an unprecedentedly higher income this year and therefore have moved up to the tax bracket, you can choose to defer some of that to the next year, effectively paying a lower tax rate this year. Remember, you only can pay tax on income taken in. Number 6 is take advantage of business tax credits that you qualify for. The IRS has quite a number of business tax credits that many small business owners don't know about. Many of these are quite specific and can change each year, which is why as a business owner, you want to go through them to figure out which one applies to your type of business. There are credits for hiring from certain demographics like Native Americans, being energy efficient, paid family and medical leave, and venturing into new markets, just to name a few. So why do tax credits matter? Well, you get to subtract them from your taxes, not your taxable income, but your actual tax bill. Number 7 is write off your bad debt. As a small business owner, few things suck more than customers who refuse to pay their bills. If you have some debts in your records that you're sure aren't going to be paid, in other words, bad debts, then you might get some relief by writing them off on your tax returns. That's right, the IRS allows for bad debt deductions from gross income, but be sure to check what qualifies, as there are some rules here. Number 8 is don't forget past losses. If you've been running your business for a few years now, then you know that the first years don't bring in much in terms of profit. In fact, most businesses need at least 18 to 24 months to turn a profit, with 20% failing in the first year. If you weather this first few years and your business is finally making something, first of all, congratulations. But now that you're making income, the IRS will tax you. Now, the good news is you can offset some of these past losses by classifying them as net operating losses on your current and future tax bill. And if you're still struggling to break even, you want to keep those records for future when you do start making a profit. Number 9, lastly, is consider switching to a corporation. Sticking to a sole proprietorship is best when you're trying to establish yourself as an entrepreneur and aren't really making much. It keeps things simple for you. However, as your income increases and consequently your tax rate, you might want to consider restructuring your business into a C corporation, especially now when the federal flat tax rate for corporations is quite low at 21%. This is compared to the highest federal income tax rate, which is 37%. However, remember, if you or your shareholders takes the company's profits as distributions, you will pay income tax, which unfortunately leads to double taxation, so be careful with this. Also, you want to keep in mind that restructuring is an expensive process, so you only want to do this if your business is earning at least $100,000 and above. All in all, proper tax planning is important in reducing your overall tax bill, so be sure to follow these tips and consult with a tax advisor if you truly don't understand. Have some more tax planning tips to add? Let me know in the comment section. If you learned something new today, be sure to like, subscribe, and turn on those notifications for more practical financial tips just like these. Until next time.